The most respected financial regulator on earth rejected 90% of every crypto company that applied. Ripple was not one of them. And what happened next is the part the American crypto community has not been paying attention to. The Bank of England is now calling stablecoins a new form of money. Global stablecoin volume just hit $4.5 trillion in a single quarter. And the regulatory framework that the United States is racing to pass before July 4th has already been operationalized in the UK, in the EU, in Singapore, in the UAE, in Japan, by the companies that did the work before anyone said go. Before we get into this, had you heard about Ripple's UK approval before today? Yes or no in the comments right now. I read every single one. Welcome back. This is not financial advice. This content is for educational and informational purposes only. Always do your own research before making any financial decisions. If you find this kind of global regulatory coverage useful, hit the like button. It helps this channel reach more people who need to see this. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. But this is the part almost nobody understands. Start with what the UK's Financial Conduct Authority actually is. The FCA is the UK's primary financial regulator, the body that determines which companies are legally permitted to operate inside British financial markets. For banks, pension funds, and major institutional investors in the UK, FCA approval of a counterparty is not a formality. It is a credibility marker. That distinction matters. It tells those institutions that a company has passed a rigorous standard, the same level of scrutiny the UK applies to its traditional financial sector. That context is what makes the 90% rejection figure significant in a specific way. The FCA applied its standard to the crypto industry and found that the vast majority of applicants could not meet it. Some were rejected outright. Others withdrew their applications after determining the requirements were more demanding than they could satisfy. 9 out of 10 companies that walked through that door were turned away. Ripple walked through it. Back in January of this year, Ripple received FCA approval to offer its payments products and its Ripple payments stack in the United Kingdom. That registration makes Ripple one of the very few crypto companies approved for long-term legal operation in one of the world's most respected financial jurisdictions, at the exact moment the vast majority of the industry was being declined. And this is where the story becomes dangerous. Ripple's position inside the UK framework extends beyond that registration. Recently, the FCA released what is known as PS25-7, its formal policy statement on fund tokenization and public chain support. A policy statement is the final published output of a formal regulatory consultation. It is the regulator's official decision after reviewing evidence and hearing from industry participants. PS25-7 was described as a major win for the UK's digital asset ecosystem, and at its center is a specific and consequential confirmation. Tokenized funds can use public blockchains as their primary record. In plain terms, tokenization means converting real-world assets, investment funds, government bonds, property portfolios, into digital tokens that can be tracked, transferred, and settled on a blockchain. Whether regulated funds could formally use public blockchains as their official record had been an open regulatory question for years. PS25-7 answers it. The answer is yes. Ripple is named in that document alongside other major players. Ripple has been at the table helping develop the industry standards that PS25-7 now formalizes in regulation. A model called D2F, which stands for Direct to Fund, and is part of this framework. The efficiency of the D2F model aligns directly with the speed and settlement capabilities of the XRP ledger. The path to institutional real-world asset tokenization in the UK is described as now wide open. Now here's where things get serious. PS25-7 does not exist in isolation. The Bank of England recently confirmed it is scaling back its strict stablecoin rules following pressure from the industry. At the same time, the FCA designated stablecoin payments as a major priority for 2026. Two of the most important regulatory pillars in British financial markets are pointing in the same direction simultaneously. Ripple's policy director for the UK and Europe, Matthew Osborne, published analysis with OMFIIF, a major global financial policy organization, arguing that integrating stablecoins into the regulated financial safety net is key to global stability and innovation. The central finding: stablecoins are no longer a niche experiment. Their total market value now exceeds $300 billion. The argument put to OMFIIF was that central banks should channel stablecoin momentum rather than resist it, and that argument has begun landing at the highest levels. The European Central Bank recently noted the benefits of stablecoins for cross-border payments and stated that the financial ecosystem of tomorrow will host multiple forms of money. The Bank of England said stablecoins could support faster and cheaper payments as part of what it described as a multi-money system underpinned by central bank money. The OMFIF analysis was explicit. Stablecoins are more likely to complement the existing financial system than replace it. Evolution, not revolution, and what happens next changes everything. The regulatory frameworks now being built globally confirm this direction. In Europe, the EU's MiCA regulation, its markets and crypto assets framework, is already in force. The UK, the United States, Singapore, the UAE, and Hong Kong are advancing their own frameworks. These rules restrict risk-taking, strengthen governance, apply anti-money laundering standards, and bring stablecoins inside the financial safety net rather than leaving them outside it. The Bank of England's executive director, Sasha Mills, confirmed the central bank's position directly. It is treating stablecoins as a new form of money. The UK's Economic Secretary to the Treasury, Lucy Rigby, said digital assets have the potential for complete transformation of the country's financial markets. These statements did not come from a crypto conference. They came from the people who operate the British financial system. Because once you understand who was already approved before the door was opened to anyone else, you realize the race for institutional adoption was decided long before retail knew the race existed. The answer to the question planted at the top of this video is now clear. Ripple is in this position because it spent years doing what most companies in this space did not: building regulatory relationships, publishing serious policy research through organizations like OMFIF, and sitting at the tables where these frameworks were being written. The UK's financial establishment is now reflecting that work back in its formal published policy documents. Ripple did not show up after the door opened. It helped build the door. But this is the part almost nobody is connecting. And the question worth asking now, if the UK is this far along and the United States is approaching the Clarity Act at the same time, what does the data actually show about what regulatory clarity does to infrastructure that is already in place? The Genius Act was the United States legislation specifically governing stablecoins. It passed in the third quarter of 2025, and the effect was measurable and fast. Through the second quarter of 2025, stablecoin transfer volume was growing, but slowly. Volume ran between $1 trillion and $2 trillion per quarter, large in absolute terms, but the pace was incremental. The Genius Act changed the pace entirely. In the third quarter of 2025, the quarter the legislation passed, transfer volume jumped to $3 trillion, then $3.7 trillion in the fourth quarter of 2025, then $4.5 trillion in the first quarter of 2026. A new record. In 3 quarters, total stablecoin volume more than doubled what had taken 2 full years to build. That is what happens when regulatory clarity arrives for infrastructure that is already operational. The infrastructure did not need to be built. The hesitation preventing it from operating at scale needed to be removed. Clarity removed the hesitation. Now here's where things get serious for the players inside. Look at what individual players did inside that environment. Visa, one of the most established payment networks on Earth, expanded its stablecoin settlement operations to 9 different blockchains and reached a $7 billion annualized settlement run rate, up 50% from the prior quarter. Fireblocks documented this in its Stablecoin Signals report. Visa does not expand infrastructure it does not intend to use at commercial scale. Circle, the company behind USDC, the regulated US dollar stablecoin, reported record revenue in the first quarter of 2026. USDC transfer volume surged 263%. Revenue and reserve income reached nearly $700 million, up 20% year over year. USDC in active circulation reached approximately $77 billion at quarter end. Reported figures, not projections. Meta, the parent company of Facebook and Instagram, returned to crypto payments by launching USDC payouts for its creators on Solana and Polygon. Meta's creator economy spans continents and currencies. Routing those payments through USDC on public blockchain rails is a live commercial decision, not a concept test. PayPal restructured. In April of this year, it reorganized its entire business so that PYUSD, its stablecoin, sits alongside Braintree and its merchant tools in a single unified payment services offering. PYUSD is now available in 70 markets. That is a business structure built around stablecoin infrastructure as a core product, not a feature. And this is where the story becomes dangerous to underestimate. Brian Armstrong, the head of Coinbase, explained the underlying logic. Trading was crypto's first major use case, but stablecoins and tokenization are now showing how crypto can modernize the financial system itself. Credit cards cost merchants 2 to 3% on every transaction. Wire transfers can take half a day and cost $50. USDC, by contrast, can be sent anywhere in the world in under 1 second for less than 1 cent, and it works in every country on Earth. Those are not marginal improvements on an existing system. They are structural differences in how money moves. Think about someone you probably know, a person in their late 50s who built their savings carefully over decades, not through shortcuts, through consistent, patient decisions across a long career. They came to the idea of digital assets not because they were chasing quick returns, but because they could see the financial infrastructure changing around them, and they wanted to understand it before it changed completely. They held through years of skepticism from colleagues and family members. They watched the debates. They read the reports. They waited. What the data from the past 3 quarters tells that person is specific. The institutions that were waiting for regulatory clarity, Visa, Circle, Meta, PayPal, began moving the moment that clarity arrived. The infrastructure was already there. The clarity was the final piece, and what followed was not gradual, it was fast. Now here's where things get serious for the US timeline. The Clarity Act is the next piece of clarity for the broader digital asset market beyond stablecoins alone. The Senate floor vote is expected in the window between June 1st and June 18th, the most realistic window for a full Senate vote according to current reporting. A backup window exists between June 22nd and June 26th. If it passes the Senate and moves to House reconciliation, the estimate is that President Trump could sign it into law by July 4th. Here is the detail worth slowing down on. There is a 360-day window after the Clarity Act is signed before it fully takes legal effect. 12 months of structured implementation, similar in design to what followed the Genius Act, during which the industry adjusts to the new rules. 12 months during which the companies already holding regulatory approvals in the UK, the EU, the UAE, and Japan are positioned to operate under the new framework from the first day that window closes. What happened to stablecoin volume in the 12 months after the Genius Act's implementation window began? 3 trillion, 3.7 trillion, 4.5 trillion. The pattern is documented. The question worth carrying forward, the one this video does not fully close, is who makes the major announcements when clarity passes, what those announcements look like, and which companies were already inside the regulatory frameworks when they happened. But this is the part almost nobody is sitting with. Step back and look at the full picture. The FCA rejected nearly 90% of all crypto firm applications. Ripple received approval in January of this year. The FCA then published PES 25.7, its formal policy statement on fund tokenization, and Ripple is named in that framework. The D2F model, developed with Ripple's involvement, now has formal regulatory backing in the UK. The Bank of England confirmed it is treating stablecoins as a new form of money. The UK's Treasury Secretary said digital assets have the potential to completely transform British financial markets. And the UK has signaled that it wants regulatory alignment with the United States on custody, stablecoins, and market structure. The alignment signal matters more than it looks on the surface. The biggest structural obstacle to institutional adoption of digital assets was never the technology. The XRP ledger works. Stablecoins work. The obstacle was regulatory fragmentation. Different rules, different definitions. No shared framework that a global institution could use to operate across borders with confidence. That fragmentation created hesitation. Hesitation kept institutional capital on the sidelines. When the US and the UK, two of the most consequential financial centers in the world, begin speaking the same regulatory language on custody, stablecoins, and market structure, the fragmentation shrinks. And what happens next changes everything for the alignment cycle. Patrick Witt, commenting on the alignment news, noted the shift is not limited to the UK. The entire world is watching the United States lead on regulatory treatment of digital assets. Singapore, the UAE, Hong Kong, and others are advancing their own frameworks in parallel. The EU's MyCA is already in force. The era of waiting for clarity is ending. It is being replaced by building for the infrastructure already being laid. The data confirms the direction. Stablecoin volume went from $1 to $2 trillion per quarter before the Genius Act to $4.5 trillion per quarter in just 3 quarters after it. Visa at $7 billion annualized. Circle at nearly $700 million in revenue. Meta and PayPal restructured around stablecoin infrastructure. And tokenization of real-world assets is projected to reach approximately $30 trillion by 2030. A projection being tracked not only inside the crypto community, but by the institutional analysts now directing capital into this infrastructure. And this is where the story becomes dangerous to ignore. The Clarity Act is approaching a Senate vote with June 1st through the 18th as the most realistic window and July 4th as a target. After that, the 360-day implementation window begins. The same structural design that followed the Genius Act, Ripple is already approved in the UK, named in the FCA's formal policy framework, holding its EU-level approvals, active in the UAE, Japan, and other regulated markets around the world. For the person who has been watching this build for years, through the skepticism of people around them, through the regulatory debates that seem to never resolve, the pattern now visible is the one that patient, research-driven observers had been tracing from the beginning, not a sprint, a structural build, the UK's shift, the ECB's language about multiple forms of money, Ripple at the table in Peace 25/7, the Genius Act's measurable effect on volume, the Clarity Act approaching its Senate vote. These are not separate stories. They are the same story confirmed from different jurisdictions by different institutions. Now here's where things get serious for the announcement cycle. And the question that remains open, the one worth watching, is what gets announced once clarity is signed? Which companies move first? What do those announcements look like? And where specifically do they come from? The institutional players who understand the global convergence, the UK approval, the EU's MICA, the US Clarity Act, the Singapore framework, the UAE positioning, are not waiting for retail to catch up to the geography of what has already been built. The compliance departments at the major banks are reading the global regulatory map right now. The mandate amendment committees at the major asset managers are evaluating which counterparties hold approvals across the jurisdictions their clients operate in. The product committees evaluating tokenization partnerships are reviewing which infrastructure providers have the regulatory standing to operate across multiple regimes simultaneously. The list of companies that hold those approvals across the UK, the EU, and the major Asian and Middle Eastern jurisdictions is extremely short. The companies on that list will be the ones whose names appear in the partnership announcements that follow the Clarity Act signing. The companies not on that list will be calling the companies that are. That is the announcement cycle that Patrick Witt and the policy analysts are watching. That is the cycle that the patient research-driven holder has been positioned for through years of skepticism from the people around them. Regulatory frameworks don't announce winners. They confirm who was already standing inside the room when the rules were being written. The list has already been made. The names are about to become public. Before I sign off, I want to hear from you. After everything we covered today, what surprised you most? Drop it in the comments. 2 or 3 words is all I need. If this video gave you a clearer picture of what is actually happening, go ahead and like it. It helps this channel reach more people who need to see this. And subscribe so you do not miss the next breakdown. Because when the Senate floor vote schedule lands, when the first Post-Clarity Act institutional announcement drops, when the 360-day implementation window opens, and when the first cross-jurisdictional tokenization partnership goes live, my analysis drops within hours of each event. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed, stay positioned. I will see you in the next video.